Good. 11 o'clock, we can get going. So thank you very much for everybody who's tuned in today. I'm going to be talking to Ian Lance from Temple Bar in a minute. But as usual, before we do that, we've got a little bit of news to cover. Finally, we've got to a point in the month where people seem to have gone on holiday and things are quieting down a bit. So I've picked out a few things. Basically, these are all things that I hold. That's not the reason I picked them, but nevertheless, I think they're interesting. Bluefield and NextEnergy Solar first. Both of these announced quarterly NAV numbers this week, and that's the reason I'm picking it up. And if you look at the Bluefield chart, and it's actually more obvious on the NextEnergy one, the NAVs have been trending downwards for a long time now, and I guess this is starting to be slightly unnerving. It would be good to see that come to an end at some point. Now, the main reason for that is the power prices. So we've had yet another revision to power price forecasts. This is looking out not in the next few months, but looking out for decades hence. Most of them use a whole range of different power price forecasters and take the average of them, or it depends on how conservative they are and the way that they do this. But no, so what we're saying is that this is not just one forecaster's numbers that are coming down; they all are. I'm not sure I understand it, as I will explain, and I'll talk about it a bit more in a minute. Just a few other things that were going on in the middle of this. Solar first, I thought this was horrendously confusing, but basically what they're saying is that actually the generation that they achieved wasn't too bad, although it could have been better. The reason why it was good was because we had a lot of sunshine, as we've all been experiencing. But coming with the sunshine normally comes lower wind speeds. But they do say that the wind speeds did pick up in the quarter, but the real problem was that they had a lot of outages. So that's both on the solar portfolio. So DNO is distributed network operator, or distribution network operator, sorry. So they are the local grid basically that connects your solar plant or wind plant to the national grid. So if they've got an outage, then obviously you can't actually sell your power. And that's particularly bad in the wind portfolio. Now the Bluefield's got a lot of wind turbines, and they're just scattered around the country, but they're mostly like ones and twos. They're like sort of fairly small. So what we saw there is quite a big drop, and I think that relates to they've got a couple of bigger plants, and that's the reason that we had an issue. So that's generation side of things. On the portfolio, they've actually done another disposal, which is good news. I've always loved this thing that they've done. They've done this joint venture with GLI Infrastructure, which is a consortium of UK pension funds, and they are selling into that assets and using the money that they free up to reduce their debt and to fund the stuff that they want to do in terms of new builds. So they've actually sold an existing operational plant, Moxwell Farm, and a battery storage project at the same place into the joint venture, but they've also sold in a portfolio of ready to build projects. So these will be developed, but Bluefield won't just have to put as much money in, and the money that it does put in is sort of come from GLL anyway, and obviously it gets to manage these too. So this is sort of ticking the box for shareholders. This just doesn't really work for them, and they've got contracts in place for these new projects that they secured in the auction rounds. So the AR5, which was 3 years ago now, 2 years ago now, 2 years ago now, they got £47 a megawatt hour for. That's in 2013 prices, so in real terms it's about 68 quid. The ones that they did last year, they got just over £50 a megawatt for. That's about £72 today, and they contrast pretty nicely with the current power price. So basically what we're saying is that they will earn money in line with the current power price, but those earnings are indexed using CPI, so that will gently rise over time with inflation. So that gives them a sort of guaranteed income for those projects. That means that they have comfort that it makes sense to build them. And that's the whole point of doing these auction rounds. And then we're waiting for the result of AR7. That's going to come out. I'm guessing that the fourth asset will go into that. And there's been talk that the prices will be higher again, and we will see what happens. Anyway, so that's freed up £38 million. That helps reduce the revolving credit facility and help fund some projects. So tick, tick, tick. NextEnergy Solar, we've got the similar sort of hit from solar power price forecasts in there. We saw a little uptick from inflation. I think actually with all of these funds you're going to see another uptick because RPI for July actually came in at 4.8%, and in their numbers they're still assuming it was 3.9. So it could be that inflation gets revalued upwards again within the NAV, which is good news. So that's helpful, but this just shows you graphically what's been going on with the power price forecasts. And you can see there, so the grey line is the oldest one of those, and in March they brought the near-term numbers down quite significantly and slightly upped the long-term forecasts. But look at the June curve and it's way behind over almost every time period. So it's actually they've actually really slashed the forecasts here, and the assumptions that are going into the June NAV are even lower again. And to me, this doesn't really make sense because if you talk to Pantheon Infrastructure and you read our note on Calpine in there, or if you talk to Ecofin Global, or if you look at some of the stocks in Polycap Technologies portfolio, power generators almost everywhere are seeing bin times because the price of power is being driven up because demand for power is so strong because it's coming from AI. And I don't see how that's going to go away, and I don't really see how then you get these dramatic drop-offs in power prices that they're forecasting here. Maybe way out you get fusion and all this sort of stuff, and we never know about that. But to me this seems overdone, and I wonder whether we're finally at the floor of this. I really hope so, because if we just still keep edge down, that's really not good news for sentiment. Anyway, the problem that we've got with NextEnergy now is that because the NAV's come down, and obviously the debt doesn't come down, the gearing is about 99%. They look at it on a gross asset value basis, so 49.5. As one of the brokers has flagged, they've got an investment policy limit of 50%. So they do have headroom on the revolving credit facility. They could borrow more money, but the investment policy wouldn't let them once it gets below above 50. They really do have to get on with selling stuff. Now the structure of the debt is such that we're not worrying about this. They have the sort of fire sales of assets and all this sort of stuff. This is not where we are. The key to this is that about almost half the debt is preference shares that don't have to be repaid at the earliest until in 2030, and actually they can choose when they want to repay them beyond that, so they can delay that. So that really isn't a problem. It's just a question of the constraints that it puts on the business in terms of what they can do. Shareholders have been a bit antsy about the discount and everything else for a while. They've been, because the discount's too wide, that's triggered discontinuation votes. Last year the result was 6% in favour of discontinuation. This year that's doubled to 12.2. I suppose that's not the end of the world, especially because not everybody's voting, so it's only about 7% of the share capital. Nevertheless, shareholders are getting a bit fed up, and I really think we need to see some more progress on the capital recycling programme. This has been dragging on now for a long time. It was announced in April 2023. And you would have thought when they announced it that they had pretty good visibility on being able to achieve that. What we thought was they're going to do it by the end of that year, and obviously it's gone on and on. We need to see some disposals, I think. Home REIT I wanted to mention because they've announced a new management agreement. So unbelievably, the new manager has been in place already for 2 years, and that agreement expires for today. So there was an old fee, which is 0.75% of NAV, with £3 million minimum number, and they're switching that to kind of a monthly number, which adds up to about £2 million over the course of 12 months, and 10% of rents collected, which is pretty chunky. I mean, yeah, if this was a normal ongoing fund, we'd all be screaming, this is ridiculous, it's way too high. But there we go. This is obviously needs a lot of work. There's a cap of £1 million on that, so basically they get back to their £3 million again. And then everything changes if they sell the portfolio. Then the management fee drops off quite quickly, and there's sort of like a sort of caretaker amount of £42,000 a month until termination. Rents have been averaging about £1 million a month. This came from the end of April figures that they announced. And they had cash in the bank then, they had no debt, they had 857 properties, about 5 of them were up for sale, and they had offers for the whole portfolio that were due diligence was started, and they thought they would get the sale done by Q3 2025, which is where we are now. So they have to get it done before the end of September if they're going to meet their deadline. But as we know, Home REIT are not brilliant at meeting deadlines. The money is supposed to be given out to shareholders, but everything is complicated by the shareholder litigation, and really it'd be good to see some progress on that. And obviously we still haven't even got the accounts, so this is why it's still suspended from trading. It's been suspended since January 2023, and they keep announcing they're going to definitely going to get these out, and they're not doing it. So in this thing that they said in April, they said we'll have the interim accounts for February 24 by the end of the second quarter 2025. We're way past that deadline. It hasn't appeared. They've only got 8 days to do the one after that. I just don't think this is going to happen. I can't see that the shares are going to relist before they announce the disposal, but, which is slightly frustrating too. And when they started talking about things in May, there'd been no real change to the litigation. As I say, it'd be really good to get on with this. In the meantime, the manager entities have gone bust, or they've gone into administration. That doesn't mean all is lost, because the whole point of the litigation is to try and go after the insurance pot that's there, hopefully. That's the reason that I'm signed up to it, and I would like to see progress on this, and it's getting frustrating now that we haven't seen anything happening. Anyway, that's enough from me. Let's now bring in Ian. And I'm going to hand over control of the slides to you. And tell us all about Temple Bar, please.
Thank you. Morning, James. Morning, everyone else. So I'm going to spend, I guess, about sort of 15-20 minutes talking through this, and then very happy to take questions afterwards. And I'm roughly going to do 3 things. First thing is I'm going to sort of review performance of Temple Bar. Second thing I'll do, I'm actually going to spend sort of 5 minutes looking at UK banks, because that's been a big part of the strong performance of the trust, and then I'm going to finish with just a look at how we see the market at the moment. Now, these figures you see in front of you here are actually up to the end of July, so actually I updated them yesterday, and as things stand at the moment, over the last year, Temple Bar, this is the share price I'm talking about, by the way, is up 32%, which compares with 15 for the UK market, so just over double. Over 3 years, up 77 versus 35, so again more than double. And this was quite pleasing to see. Was when I updated this yesterday. We started running the trust on the 30th of October 2020, and as of yesterday we were up 200%, which is just crossed the 200% figure, which compares with 89% for the UK market, so more than double. But another interesting fact, the S&P 500 is up 100%, so we've actually doubled the S&P 500, which I think might surprise a lot of people. What my 3 takeaways from this: number one, despite what a lot of people will tell you, actually active management does work. Again, a lot of people will have told you over the last few years that that value investing is dead. Well, those figures would seem to suggest value investing is not dead. And number 3, it would appear that you can actually make decent money in UK equities. So three interesting takeaways there. Moving on, I'm going to quickly skirt over this. This is the sector split. You can see financials remains one of the biggest parts of the portfolio. This is the top 10, which I'm not going to dwell on, other than really to point out the fact that despite, if you just go back to the figures that I was just quoting, the fact that the trust is up 30% in the last year, you might assume that a lot of the stuff that we own is now getting pretty valued. And yet, look at these valuations on the top 10. I mean, lots of stocks there, are trading on PEs of sort of 10. And look at the dividend yields. Dividend yields between 4 and in some cases north of 6% on these stocks. So actually, despite the fact that the trust has done well, we still do see a lot of value. Let me move on to talking about the banks. You might remember, I'm not going to name him, but a couple of years ago, a very well-known fund manager wrote a piece in the Financial Times basically saying that he would not invest in banks at pretty much any valuation, any share price. He just wouldn't invest in them. And actually, we wrote a riposte to that at the time because we just didn't see life like that. And here in front of you, you've got 3 of the banks that the trust owns and has owned throughout this period. So you've got Barclays on the left, NatWest in the middle, Standard Chartered on the right hand side there, and you can just see how the share prices of these things have been absolutely phenomenal. Look at over the last 5 years, Barclays up 330%, NatWest up 530%, and Standard's up 300%. So what's going on there? I'm going to sort of quickly take you through what I think has happened there. But actually, reason number one is, and the reason why we thought it was ridiculous at the time to say that to never invest in banks, was the starting point. So if you just sort of focus on, I suppose, where these things took off, it was round about the end of 23, start of 24. So take I know something like Barclays, the share price as we went into 24, you can see was about £1.50. Well, they were just about to report their earnings, their results for the end of 23. So in sort of January 24, they report obviously their 23 earnings. They were about to report 40p of earnings, okay, and the share price was £1.50. So that was trading on about 4 times earnings. That's, ditto NatWest. And NatWest, you can see going into 24, share price is about 200. They were about to report 50p of earnings. So again, trading on about 4 times earnings. You get the picture. So the start points for these things were incredibly low. For some reason, people just didn't want to know UK banks back then. And if we move on, this wasn't just a case of sort of, here was some sort of very cheap but not particularly good businesses, because what I want to go through in the next couple of slides actually is more to do with the fundamentals. And in all cases, we've got Barclays on the left, NatWest on the right. NatWest in the middle and Standards on the right. And as I'm sure lots of you know, one of the key things that drives a bank's profitability is what's called their net interest margin. So literally the spread between what they're funding themselves at and what they are lending money out at. The wider that goes, the more profitable they become. Just look what's happened to that net interest margin in the last few years. So Barclays has gone from 3 to 4.3. In the case of NatWest, you've gone from 1.5 to 2.1. In the case of Standards, 1.2 to 1.9. So obviously that was incredibly healthy for their profits. And then at the same time, so obviously that's the sort of revenues almost, if you want to think of it that way, going up. Look what happened to the cost. So the cost to income ratio has been going down. Barclays 67 down to 62. NatWest 70 down to 53. I mean, interesting point here, by the way. These businesses are benefiting from things like AI. Clearly, they're not involved in the whole AI bubble, but they are beneficiaries of technology and AI, and obviously they're able to reduce the number of staff that they use and so on and so forth. So effectively you've got some jaws there where the income's going up, the cost going down, and clearly that's very positive for profitability. The other thing that tends to this is very important for a bank's profitability is loan losses. So obviously you go into something like great financial crisis, loan losses go up, and because banks are geared, it knocks a big hole in their P&Ls. And and this has been positive as well. I mean, probably the standout one there. Look at NatWest in the middle. Look at the way that the loan losses have come down over the last few years. Standards on the right there as well. So that has been positive. You can see the non-performing loan ratio there as well. Coming down to about 1%. And I suppose putting all of this together, this slide shows you what all of those things have done to the profits of those businesses. So, I don't know, let's take NatWest again. So, 28p of earnings in 2021, and then we go 40 and 53. And by the way, these are forecast to keep going up in the next couple of years. I haven't put the forecast years on, but these are forecast to carry on going up. Look at standards on the right hand side there. 55.80, a pound, 1.30. I mean, tech type earnings growth available on a price earnings ratio of 10. Look at the return on tangible equity. I mean, these businesses are making now some very, very good returns. The standout one there being NatWest in the middle. NatWest is making an 18% return on tangible equity. And then if we sort of finish off with the valuations, clearly they're not as cheap as they were, but that's only because the start point was just ridiculously low. They are still pretty cheap. So these are historic earnings we're looking at here. So you can see, NatWest on a historic PE of 7. On a prospective PE, so the price today divided by next year's earnings, NatWest still under 10 times. Under 10 times earnings. The bottom one, people will often use price to tangible book when they're looking at a bank. And again, just look at the start points. These things were trading on half their tangible book a couple of years ago, which was a very, very attractive entry point. Clearly that has gone up, but again, we are looking at, so NatWest is trading at a slight premium to book, and it should be because it's making an 18% return. The others still trading on discounts to tangible book. And then one final thing, this when I've presented before on the show, one of the themes that I've been talking about for the last couple of years is share buybacks. In other words, the fact that we have been banging the table with the companies that we invest in, saying to them, look, don't get frustrated about your low valuation, use it to your advantage by buying back your own stock, because when you buy back your own stock at a very low valuation, it is incredibly accretive for your own shareholders. And these companies have probably been the biggest proponents of that in the last couple of years. So the way these charts work, the black lines are the share count, and you're using the right hand axis there. Obviously the green is the share price. So look at Barclays. So Barclays had basically kind of 17 billion shares in issue a couple of years ago, and we're now down at 14. With NatWest, we've gone from 11 down to 8. So we're talking about a third coming off the share count in probably sort of 3 to 4 years. And when you combine that, so your share count is coming down, fairly obvious what that's going to do to your EPS. And when of course when the underlying business is also doing well, you put all those things together, and that's been incredibly incredibly good for the company. So this has been a big feature of Temple Bar over the last few years. I suppose the final thing that I will say is if we go back to the top 10, probably last time I went through this, I suspect in the top 5 you might have seen 3 banks, and now we're looking at top 10, and the only one that is appearing there is NatWest. So you say, what explains that, given that I've just been so sort of positive on the banks? It's really just reflecting the fact that, number one, they became very large parts of the portfolio. And having done so well and having become such a large part of the portfolio, we thought it seemed to make sense to take money out of them and recycling it into other opportunities within the portfolio. And the second thing is, I think one always has to try to look forward, not backwards. And when you look at some of those numbers that I've just been through, you could almost say things are unlikely to get any better than this. Things are so good at the moment, they're unlikely to get better. And at that point, it's normally good as well, isn't it, to start taking money out of an area. So, absolutely don't think they're expensive. We think the underlying fundamentals remain good. We think they'll probably carry on buying back stock, but it just seems sensible, we think, to start to sort of take money out of the area. So that's the banks. I hope that was interesting. I'm going to flip on now to, I suppose, market outlook. And I think a couple of slides here, and I hope this will be interesting for you, because it's fascinating to me how different the market is this year. So this is just a chart of different markets around the world, and of course we've all become used to, haven't we, the last few years. Over on the right hand side would be S&P 500, Mag 7, Nasdaq, etc, 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 and over on the left hand side would be the poor old FTSE 100 and the Euro stocks and so on and so forth. Just look at the performance of markets year to date. I mean, really, really different to the last few years. So over on the right hand side, we've got IBEX up 35%, DAX up 26%, the FTSE up 14%. As I said to you earlier on, Temple Bar up 30% year to date. And then look at the S&P 500 up 3%, Nasdaq up 4%, Mag 7 up 2%. So, this year, obviously they had a big sell-off sort of at the start of the year and have recovered from there. But when you look at it from January the 1st, actually the returns have not been that spectacular. And of course, worth pointing out, by the way, all these figures are done in sterling, so you also have the beneficiary of the fact that the US dollar has been slightly weak. And ditto when you look at companies. So look at company performance. So over on the left hand side, I've sort of just randomly picked some of the quality growth darlings of the last few years. So some of the stocks that everyone loved because everyone used to sort of wax lyrical about their moats and their unassailable positions and so on and so forth. And I think don't get me wrong, some of these businesses are good businesses. It's just that you always need to remind yourself that there's a right and a wrong valuation, and if you fall in love with something and just pay way too high a price for it, eventually the expectations become higher, and if they disappoint even slightly, the share price can go down quite a long way. And probably the standout example of that is the Danish drugs company over on the left hand side there, Novo Nordisk. So they make Ozempic, one of the diet drugs, and people just got incredibly carried away with the prospects for that. And they're not going backwards at all. The growth rate has just slightly slowed down. Look at the performance year to date. Well, you've lost 2/3 of your money in the last year in Novo Nordisk. I think it's something like 80% off the top now. Another stock, LVMH, that people used to just absolutely love. That's lost a quarter of its value in the last year. Diageo, we probably know. I think Diageo is now halved off the top, down another 20% this year. So, again, a very, very different picture. And now go to the right hand side. I mean, some of these I think are just going to blow people's minds. Who would have thought that international consolidated airlines, in other words, British Airways, could be up 136% in a year, or even something as dull as BT Group. Who would have thought a UK telecoms company could be up nearly 60% in the year? And obviously we've got Barclays and Standards and so on and so forth. So just a very, very different picture. I'm just going to canter through a couple of other slides, and then I will finish and take questions. The US to us still looks very, very expensive. This is just a very long run chart of the US versus global equities. So it goes back to the 1970s, and I think that's useful to do because you can see we've highlighted the previous two big bubbles. So in the sort of late 60s, we have what was known as the Nifty 50 bubble. Interesting to look at what happened after that. So that sort of popped in about 1970. The US underperformed the rest of the world until 1990. So you had 20 years in which the US underperformed the rest of the world. I think people have almost forgotten that could happen. 2000, obviously, you got the internet bubble. That was then we had a pretty savage setback from that. But just look where we are today. The Magnificent Seven bubble. If I asked you to just try and predict next 5 years, do you think that line's going up or down? I'm guessing most people would probably say down. And yet a lot of people still have very, very high exposure to the US equity market. This is actually a 100-year chart. So this actually starts on the eve of the Wall Street crash. It's just the valuation of the US stock market, and it's a sort of market cap to GDP type valuation ratio. And the point here is, today you are buying the US stock market at the highest valuation that it has seen for 100 years. Higher than 2000, higher than 1970, higher than 1929. So again, just think about that in sort of probabilistic terms. Do you reckon your chances of making a good return buying it at that sort of level are good or bad? I would have thought bad. So on the flip side, I would say the UK to us, clearly it's done better in the last year, but I just would keep coming back to this thing about start points. And don't anchor off those start points, because those start points were so extreme. So that chart on the left there, it's the valuation of the UK relative to MSCI World. And again, we're looking at a 50-year chart there. The 50-year average is that the UK trades at a 17% discount. We got all the way down to something like a 45% discount, and we're now probably at, I don't know, 42 or something like that. So yes, we've bounced a little bit, but my God, we've literally only just bounced off the bottom. There's an awful long way to go if we just get back to average. So just keep that in mind. And final chart from me, and then I'll pause and happy to take any questions. It's a similar picture with value versus growth. So this chart here takes a little bit of explaining. What you're looking at is the valuations of the cheapest bit of the UK stock market, call that the value bit, versus the valuations of the expensive bit, let's call that the growth bit. And that line is not a static line, it goes up and down over time. When it's going up, that's basically growth stocks becoming kind of growth stocks becoming more expensive. When it's going down, that's value becoming cheaper. So look at the line sort of running into 2000. As that line's going down, that's basically growth becoming more expensive, value becoming cheaper. Eventually you get the sort of bursting of the the TMT bubble, and then you get the 5 amazing years of performance from value. Again, just so now sort of cast your eyes to the right hand side of that chart. Post the pandemic, look where that line got to. That line, the stretch in valuations between value and growth was wider than it was in 2000. So at the start of the pandemic, the spread between value stocks and growth stocks was enormous. Now value has done well for the last couple of years, but again, just look at where we are relative to the long run average. So the long run average is kind of minus 40. Yeah, value, you would expect value stock would trade at a discount to growth stocks, obviously. But the long run average is 40, and we got to 65, and we've got back to today probably, I don't know, 58 or something like that. So, still an awful long way to go for us just to get back to the average. And I mean, obviously, it's very possible, looking at the history, that you go above the long run average, don't you? So I suppose in summary, yes, things have been good for the last couple of years, but please don't anchor off those start points. We really don't think this is over. That's me, James. Happy to take questions.
There we go. I'm back. Cool. That's really good, Ian. Thank you very much. So one of the things, I mean, within the UK, it's I agree with everything you're saying, but one of the things that we've also seen is that small cap is even cheaper than large cap, and large cap has a bit of a bounce, but small cap doesn't seem to have really participated in that. What's stopping you from putting more of the fund into small caps?
It's the opportunity set. So I mean, absolutely agree with your starting premise. Yeah, I think small cap looks very cheap to me. I suspect there are probably some small cap trusts out there that are very, very cheap, because you've got a load of cheap stocks and it's probably trading at the discount. For us, it's almost a case of we don't really need to take that liquidity risk, because we are seeing so much value in the larger mid cap area. Why do we need to sort of migrate down into the small cap area? So it's just a case of we just don't need to take that liquidity risk at the moment, given that there is so much value in the large cap.
So is there any sort of small cap exposure at all in the portfolio now? Or?
Depends how you define small cap. So one of the stocks that we bought within the last 6 months is Johnson Matthey, which that was a market cap of 2 billion at the time that we bought it. So that's probably a little bit bigger than small cap, isn't it? But I mean that's a mid cap stock. So we bought that. We bought. I mean, hilarious. This name is could even be considered sort of mid, I suppose. Aberdeen. We bought Aberdeen. Had a market cap of 2.5 billion when we bought it. So that's outside the FTSE 100, isn't it? That's a sort of mid cap name. So yeah, there have been some names that we bought in that sort of area.
Cool. Okay. Great. Now value and growth are sort of awkward labels, really. Yep. Are there stocks in the portfolio that actually have decent? I mean, you've actually shown us some, but decent earnings growth just because the sales are going up and everything else, not because they're fixing stuff.
Yes. Could you on the slides? Could you go back to there's a chart on Smith and Nephew.
You can do that. No, that one. There we go.
There you go. Smith and Nephew. So Smith and Nephew is a really, really good business. But again, for those who don't know it, the thing that I suppose they're best known for is hip and knee implants. Anyone who's had a knee operation or a hip operation in the last couple of years, good chance you had a Smith and Nephew implant put in. And that area is known as orthopedic. Okay, so that's kind of one part, and then they've got very strong positions in sports medicine. So again, that is sort of knee-related stuff, and advanced wound management. The reason for highlighting this one is this is a really good company. So the top line for Smith and Nephew, it probably grows around 5%, and they make 20% margins across the group. In fact, the sports medicine and the advanced wound management make kind of mid-20s type margins. They throw off an awful lot of cash. They have 95% free cash flow conversion, so it's a very cash generative business. The interesting thing about this is that during the pandemic, for various reasons which I won't go into, basically their ortho business did not do well, and so profits went down. Profits took a dip, and the market did what it often does, which is had a complete freak out about this one business, and kind of almost ignored these two other businesses, which were really, really good businesses, and the share price basically halved. And you've now got basically new management team came in about 18 months or so ago, put in place a plan to basically fix that ortho business. That has started to come through. So actually, this share price appears to have troughed and improved. But this would be an example, of we would say a high quality business. Just to finish off, because I do think that's a really important point. Is people will often say, you're a value investor. Basically, that just means you buy cheap rubbish. And we always say, look, we absolutely love to buy quality or growth, or whatever you want to call it. We just don't like overpaying for it. And the example that we use is hilariously back in 2010 when we first arrived at Red Wheel. We used to own Microsoft, which is everyone's favourite stock these days, isn't it? But it wasn't back then. Back then, all the tech guys would tell you that Microsoft was just in totally the wrong areas. Business is dead. They're going to get disintermediated. Therefore, you could buy Microsoft. Go back and look at the chart. Cash adjusted P of 8, because the market hated Microsoft so much. So we as investors were very, very happy to buy quality. We would love to buy Diageo, etc. We're just not going to touch them until we think the valuation is right.
Yeah, fair enough. Thank you. Now we talked about how cheap the US is. Sorry, the UK is. Let's get it right. Yep. But you have actually got quite a lot of money in overseas stocks now. So what's the rationale for that? And are there limits around that?
Yeah, so on to the second question first. There are limits for Temple Bar. We're allowed to invest 30% overseas. The rationale for it is that absolutely there are parts of the UK which we think are very cheap. It's still quite narrow though. So you're it's still areas like sort of financials, etc., retailers, and therefore you're being forced to sort of I suppose focus in on some of those areas, and some of those areas are cyclical areas. if you use the 30% discretion to go overseas, then basically it just widens your opportunity set, doesn't it? And it means that you're not forced to just take that big sector bet on those areas. So that's one reason. And another reason is that there are just certain sectors which are cheap and they're just not represented in the UK. So technology, not a big part of the UK index. And if you can find some cheap technology names, you have to go outside of the UK to access them. So that's kind of the second reason. And then the third reason is to do with lowering stock-specific risk. And what I mean by that is, let's say that you want to, put 15% of the portfolio into energy. If you're only going to invest in the UK, that basically means you're going to have 7% in Shell and 7% in BP. And that is quite a big bet to take on those individual companies. In kind of quantity terms, that's quite large stock-specific risk. Given that it's a global sector, we think it's probably better to hold a smaller weight in them and then maybe own Total or Eni or something like that. So you get the sector exposure, but without having to take the huge stock-specific risk.
Yeah, great. That makes sense. Now, I think almost the first question we got is it true that you bought some Korean banks and why?
Yeah, we did, yeah. Because they're cheap. No, so we bought two companies called Hanna and Wari. It was some work done by a very good analyst on our team called Shaw Roston. And I remember sitting on a train reading the note that he wrote on these two companies, and almost my jaw was dropping open because they were really, really good businesses in terms of growing their earnings, very well managed businesses, very low loan losses, very sensible loan lending policies, etc., etc. And they were trading on, and they're making sort of ROEs, double-digit ROEs, and they're trading on half book. P's I think of about 4 or 5 at the time, and dividend yields of about sort of 5 or 6 at the time. And that's one of those opportunities where obviously there are UK banks. We were speaking about UK banks earlier on, but actually we thought, my God, these things really are very, very cheap. And actually when I was saying earlier on that we've taken some money out of the UK banks, well, some of that went into these Korean banks. And of course, I'd be amazed if I didn't get asked the question about the current government's desire to try to put the economy into a deep recession. By doing that, you're reducing your exposure to the UK economy as well, aren't you?
Yeah, exactly. Can you update us on the Marks and Spencer story, please?
I presume is the angle there the cyber incident.
Yeah.
Or just
the
whole story. I mean, the whole story is a really, really fascinating one, which is that basically new management team came in about 17, 18. The new chairman was a chap called Archie Norman, who's I know some people will know. So Archie Norman, just very, very capable businessman. He formerly turned around Asda. Myself and Nick, we run this trust together, met with him back then, and he literally went through a shopping list of everything that was wrong with Marks and Spencers, and they were just overcosted. He described it as being like the civil service. The stores were in the wrong places. They were grey. They had no online presence. It was a big list of things, and they basically set about fixing them. And so that kind of process started, didn't it? And then along comes the pandemic. And when we were looking at Marks, we originally thought that they were probably capable of doing about 25p of earnings per share as the improvement started to come through. In the pandemic, the share price bottomed at £1. So again, you were being offered Marks and Spencers at the start of its turnaround journey on sort of four times normalised earnings. So we bought a lot of it then. It clearly did very well. It became a very big part of the trust. We at that point took some money out of it, and then you sort of roll forward to this year. You get the cyber incident, and the cyber incident is annoying. Clearly, I think they were unlucky. What I mean by that is, it wasn't a failure of their systems. Funnily enough, the systems actually worked. so well that actually these hackers basically rang a third-party help desk and asked for a password to be reset. The policy is you're not meant to just reset someone's password like that, but they did, and they allowed these hackers into the system. And it's cost the firm 450 million quid, I think. I suppose the good news now is that basically that that's all done. The everything is back up and running now, so you can order things online. And the underlying story hasn't changed at all. So that 25p of earnings that we used to think they were capable of, they actually did that last year. So and we now think probably 40p or something is a much more of an achievable figure. Again, this story is in the relatively early days. So I was at a presentation recently, and they were saying that I think only something like sort of 30% of their customers have seen one of their new stores. I.e., there are still loads of stores to be improved. So I still think there's an awful lot to come through there.
Great, thank you. Now another question here is if sort of banks is you're starting to take money out and that's sort of not done, but it's sort of declining. Are there particular sectors here that you're excited about?
No is the answer, because actually the ideas that are coming through now, I mean, we are bottom up investors, but occasionally there are clear sector themes, aren't there? So I don't know, banks would be an example. If you look at some of the stocks we bought recently, so things like Johnson Matthey, Smith and Nephew, they are actually coming from a sort of wide variety of sectors, and actually that's quite good. We quite like that, actually, the fact that we are finding value in different sectors. Actually, could you just roll forward to that Aberdeen slide, because this might be just that one. Yeah, this might be one of the ones where people, in fact, almost certainly is, where people think, are you actually out of your mind? Why are you buying Aberdeen? And I can explain this very, very simply. If you just focus in on the chart on the bottom right hand side there, which is basically sort of our estimates of the value of the different bits of Aberdeen. And it's quite possible that actually people know the Aberdeen for fund management. They might not know that, for instance, Aberdeen owns Interactive Investor, which is the sort of Hargreaves Lansdown challenger. And that is a really good business. And you can see there, the II bit in the middle there. We think that's worth about $1.5 billion. If you valued it on the Hargreaves Lansdown takeout multiple, you can probably double that. But let's put that to one side and just call it 1.5. They also own a sort of B2B platform, which some people might be familiar with, called Advisor. We think that's worth about $1 billion. At the time that we were buying Aberdeen, the market cap of the entire group was $2.5 billion. So at that point of time, the market is placing literally no value whatsoever on the fund management business. Now, appreciate the fund management business is not brilliant, but it's not worth nothing. So that they still run 360 billion, something like that. That doesn't sound like that's worth nothing to me. The new management team, again, doing the right thing, taking costs out, trying to improve the profitability of the fund management business. So our guess is, let's call that 1.5 billion. So now we're up at sort of 4 billion, and then there are other bits and pieces. So they've got a pension fund surplus, they've got a stake in Phoenix which they could sell, they've got core equity tier 1 surplus. You add all that lot up, we will get it to about 6 billion. And as I say, we were paying 2.5 billion at the time that we were buying it. So, this. I suppose another thing I like about this is, this is loosely financials, but it's not banks, is it? It's completely different to the banks. So, yeah. So, another area where we think actually we did find some pretty good value at the end of last year. Cool.
Now you've got a chart on takeovers that I think is interesting, so I'm just going to pull that up. Here it is there. This is just sort of seems to be going on and on. I guess is it just foreigners taking advantage of cheap valuations?
Yeah, cheap. Yeah, absolutely it is. Yeah, it was. I suppose our two big themes for last year was all UK fund managers had that chart, didn't they, of how cheap the UK was, and it kind of. And people just used to glaze over when you brought it up, because everyone used to say, well, yeah, that's great, but what's the catalyst? And then last year, these two catalysts came along. One was the other one, the share buybacks, which you've already spoken about. But then there was this one, which was takeovers. And yeah, absolutely. I think overseas corporates and, for instance, private equity, we're just looking at the valuations of some of these things, thinking this is crazy. I can buy this quite decent business, and I'm going to take it out for, I don't know, 10 times earnings or something like that. In fact, I don't know if you remember, one of the stocks that we own in the trust was Currys, the electrical retailer, and an American hedge fund called Elliott came in for that at the start of last year, and the share price was 40p at the start of last year. Elliott bid 62 at first, I think, and then they raised that to 66. We both told the company, and we actually went public and said, we don't even think about this below £1. And actually, share price is £1.20 today. So actually, that was one where, despite the fact that the offer went away, actually the share price has continued to do well. But it's exactly what you say, James. It's just I think overseas corporates looking at the valuations of some of these businesses, and just thinking, this is almost too good to be true.
Brilliant. Okay, one last thing for me, I think.
Yep.
When we had the Mag 7 pullback in sort of like January, February, and there was talk then people start selling the US and buying elsewhere. Did you see that flowing into your stocks?
Well, interestingly, actually, we've seen inflows into our UK funds for well over a year now, actually, which is quite good. There was an article in the Times last Saturday, and it was specifically saying that US institutions have started buying UK equities. That is quite encouraging, actually. I haven't got it here, but I've got another chart, and it's just the size of the market caps of markets around the world. And if I told you that the UK is 3 and the US is 70 trillion, that you don't have to have an awful lot of money move out of the US and move into the UK for that to cause quite
no, literally, I've just written something else, and the market cap of the 4 largest US stocks is bigger than the whole of MSCI Europe, including the UK.
Exactly right. Yeah,
it's just bonkers. Yeah.
So one of our investors described, if people are going to move money out of the US and into some of these other markets, one of my other investors described it as like trying to pour a pint into a shot glass.
Yeah, exactly.
It's going to be quite interesting.
Yeah. Great. All right then. That's really helpful. Thank you very much for all of that. I hope we got to everybody's questions, and we will get you back again in a year's time. But
great. Thank you very much, James.
So thank you very much for listening today. There's the disclaimers. Please do go have a look at them. I'm going to leave them up there slightly long, but you probably need to pause them to read them. Have a good bank holiday weekend. We'll be back next Friday. It's one of our panel sessions. We're talking to private equity managers, and the idea of it is to help demystify a few things. But if you've got any questions, do please either submit them ahead of time or listen in and put them into the YouTube chat box. So we're talking to Alan Gould from Patra Private Equity, Steve Tredgett from Oakley, and Hamish Mayer from CT Private Equity. I think are 3 of my sort of favourite managers in the sector. So it should be an interesting one. Have a really good break. Obviously, you haven't got a bank holiday in Scotland, sorry about that, but the rest of us do. So we'll see you next Friday. Thank you.